Hello and welcome to New York and FT markets for this week. Well, it's quarter end, and more than ever the nerves are jangling. And there are a couple of reasons for this. First of all, we've got negative T-bill rates over the end of this month, which is also the end of the third quarter, and that has big implications for markets in general. And meanwhile, we've had the abdication of Bill Gross, the bond king. What does that mean, and how's that all going to play out as investors try to negotiate the end of the quarter and look ahead for the rest of the year? Joining me now to discuss this is Tracy Alloway, our resident expert on all things geeky and T-bills and repo. So Tracy, what are we seeing here? Obviously we've got negative T-bill rates, which is very unusual, even though we are in a zero-bound world. But you don't normally see people actually paying the US government for holding their cash. So what's kicked all this off?
That's right. Well, actually, one of the last times we saw negative T-bills was back during the darkest days of the financial crisis, when people just didn't want to put their money at the banks. Nowadays, we have a different dynamic going on. Basically, what's happened is that banks are a lot more reluctant to undertake what are known as repo transactions in the markets. There's all this post-financial crisis regulation that makes it more expensive for them to do repos, and that means at quarter-end time, they're just backing away completely, and investors have to go somewhere else and figure out something else to do with their cash.
And muddying the waters this time, of course, is the testing by the New York Fed. They have this reverse repo facility. They announced during after the last Federal Reserve meeting earlier this month that it was going to be capped at $300 billion. That came when people were expecting you to see at least 400, maybe 500 billion in demand. Yep. And just to remind our viewers, at the end of June, total demand for the Fed's reverse repo was 339 billion. So that's sort of hurting people at the moment, isn't it?
Yeah, that's right. I think a lot of the big investors, what are known as money market funds, thought, well, they could use the Fed's reverse repo facility as a sort of last resort to put their cash. And the facility there, it's there in order to soak up excess liquidity from the system. Now, that changed a little bit when the Fed put on this 300 billion cap, and now everyone's sort of rushing around trying to figure what to do. You can't go to the Fed necessarily because you don't know if all the orders will be filled, and you can't go to the banks because, of course, they're cutting down on repo transactions. So you're seeing this massive scramble that's sort of bearing itself out in these negative T-bill rates.
Right. And then the other factor to sort of look at, of course, is what's happening with the big player in the West Coast. I've always loved how down the years when you'd call up a source and say, why are rates moving? What's happening in credit? And they sort of whisper, oh, it's the big guy out on the West Coast. Well, the big guy out on the West Coast, we're talking about Pimco, of course, they've seen the departure of Bill Gross. They're saying everything's fine, but redemptions are picking up. We saw a big outflow on Friday from its bond ETF. We know that there are redemptions coming from its mutual funds. And we have a very different fixed income market these days compared to what we saw, say, in 2008 at the height of the financial crisis. How tricky is this going to be for markets generally over the quarter and then looking into the beginning of the fourth quarter?
I think it will be really interesting to watch, and the fact that you're seeing movement in the market now, whereas you didn't see a lot of movement in fixed income when we had, Russian geopolitical tensions.
That's a very good point, actually.
All these sort of big geopolitical stories that didn't do anything for the debt market, and now because one guy has left Pimco, I know it's gross, but still one guy has left Pimco, now you're seeing the market move. That tells you a lot about markets, as you know.
And do you think junk, I know Bill Gross is a massive advocate of owning Treasury inflation protected securities known as TIPS and sort of inflation bonds. He also liked to double in junk, which is also another area like TIPS, which liquidity is not particularly good. How much of a shakeout could we see here in both junk and inflation bonds, do you think?
I think it depends. It will depend a lot on the market. I don't want to say front-running Bill's positions, but
yes.
For the past few decades, everyone has known Bill's general investment strategy in the market, and they all are intimately aware with the holdings of the total return fund, for instance. People will be watching to see whether that investment strategy changes as the new CIO comes in, and they'll be thinking of ways that they can profit off of it.
And of course the other thing about Pimco and the total return fund too is that it relied heavily, or does rely heavily, on derivatives. I mean, trying to manage 230 billion in bonds is very problematic in these liquidity constrained markets, so hence Gross and Pimco in general have loved going to derivatives, using derivatives to put on sort of synthetic exposures in mortgages, treasuries and credit. They've also done a lot of selling of volatility, taking in insurance premium,
Right.
and as long as volatility stays low, they should be fine. But if we see a tick up in volatility, particularly in the bond market, it could get quite problematic here.
Yeah, I think that's right, and I think that's one area that we really have to watch is how the sort of hedging and leverage and derivative strategies that Pimco has used over the past few years to amplify its returns, how those bear out in corners of the market that are less visible than just, say, junk-rated debt or TIPS.
Well, as the third quarter wraps up, we could be facing a very interesting month of October, which historically has provided some pretty nasty surprises for markets generally. Thanks, Tracy.
Thanks, Mike.